Okay, perfect. We are live to our panel discussion for today. We will be talking about stablecoins again. We will touch on some different concepts and discuss like the risks, the pros and the cons. I have here four wonderful guests, Patrick Hansen from Preside Capital, Token Bryce from Liquidity, Michael Egorov, founder of Curve Finance, and Nilos from Fiat DAO. And the panel discussion today will look like this. First of all, we will start with a small introduction round. Then we will have roughly 40 to 45 minutes of discussions. And in the last 10 minutes, we want to answer some questions of the audience. You can just type in your questions in the comment section on YouTube, and then we will raise the questions at the end of the panel. So let's right away start with the introduction round. Maybe we start with you, Patrick. Just briefly explain who you are and for what company or protocol you work for.
Sure, happy to. And first of all, thanks a lot for the invitation, Christian. I'm really looking forward to the discussion. A lot going on right now in the stablecoin space. So yeah, my name is Patrick. I work currently as an advisor to Preside Capital, larger VC fund based in the US. I was previously head of strategy and business development for Unstoppable Finance, an early stage startup in Berlin, building a multi-chain DeFi wallet. And prior to that, I was head of blockchain at Bitkom. Bitkom is the largest tech association in Europe with 2,000 member companies. I was basically driving all the crypto policy and regulatory work there with a lot of crypto companies and startups and projects. And that's also where I came in close contact, obviously, with the regulatory activities around stablecoins. And I'm sure we will talk about that as well. And yeah, that's about it. And looking forward to the panel.
Thank you, Patrick. The next we have Token Bryce from Liquidity.
Hi, Chris, and thanks for having me around in this all-star panel. Same here. I'm really looking forward to the discussion. I think it's going to be really interesting and it's well balanced. So on my end, I come more from, let's say, the community side of DeFi, where in my first years of involvement, I was more focused on trying to organize a French community with DeFi friends. And then from here, I was able to get involved in several projects and essentially move to the builder side, even if I'm more in the marketing and community building side of things. And so, yeah, I've worked with Paraswap for a while, trying to help out set up the DAO when the token just launched. And more recently, a few months ago, I joined Liquidity after being, let's say, an appreciator and admirer of the project for a while, to help out both with the DeFi implementation of Liquidity, let's say, and also with a new project that's probably not relevant for today, but you might have heard about the lovely chicken bounce.
Okay, no, actually I haven't, but maybe we can touch on that right after the call because that sounds interesting. Then I would already hand over to Michael Egorov, the founder of Curve.
Hi, I guess, yeah, I don't know if any more introduction is needed in addition, so.
Okay, yeah, perfect. Then we can already go to Nilos from Fiat DAO.
Yeah, hi everyone. I'm Niels from Fiat DAO. I'm a contributor. We are like a DAO organized project. We are a collateralized lending protocol where the borrower mints our own stablecoin by depositing yield accruing, yield bearing assets.
Perfect. So we have today, I think, four real experts with real DeFi knowledge and also with basically the knowledge how to implement and structure stablecoins. And just quickly for the audience, so that we are all basically a little bit on the same level. Usually, and we have also covered that in some of our articles, we differentiate between three types of stablecoins. There would be, first of all, something called tokenized funds like USDT or USDC, where a custodial bank has to hold cash. They can then basically mint tokens according to how much cash holdings they have. And then these tokens exist on the blockchain. And there's like this redeemability between the tokens and the cash holdings. And this redeemability basically maintains this peg of like $1 that a stable coin should have. Then there's a second approach, collateral debt position stablecoins. So they are always over collateralized. I have to pay in, let's say, for example, $110 of BTC, and then I could, for example, borrow $100 of a stablecoin. This would be a CDP stablecoin. And then the last type of stablecoin that basically exists are the algorithmic ones that use arbitrage to maintain the peg of $1. So just like for the audience that basically there's like different kind of stablecoins, and today we want to discuss like basically what's the pros and what's the cons of each of the concepts. And for that, we can directly dive in with you, Token Bryce. You already said that you are involved with liquidity now for quite some time, and I think you have a stablecoin called LUSD. So now the question a little bit, in what category would your stablecoin fall of the three that I had mentioned before? And what makes the liquidity protocol as a lending protocol quite unique?
Yeah, that's a great way of framing for the stablecoin, I guess. So for us, we'll probably fall in the extreme end of the spectrum in terms of decentralization. I often describe liquidity as an opinionated protocol, and I think it's a fair description, where there was really a focus being put on resilience and trustlessness as much as possible. And the feat was pretty much achieved up to the Oracle situation, where it's always hard to have a decentralized solution here, but even here there is redundancy. So yeah, LUSD as a stablecoin, I think addresses what's still somewhat of a niche, if we're honest, which is the need for a stablecoin that's really, we like to call it disaster-proof. I think it's a good way to convey the idea where, again, there are like sacrifices made in the design where maybe the scalability is not the best compared to, I don't know, a solution like Frax, but there are like strong guarantees that are being offered at different level of both the stablecoin and the protocol. I think one of the headlines that might interest your audience is simply that liquidity is one of the few protocols that is immutable, just like Uniswap, for instance. So the code has been deployed, the smart contract code is deployed on Ethereum mainnet, and nobody can modify it. And so for a stablecoin, that's particularly interesting because you really avoid some of the pitfalls you can have in centralized models or in models that are based on centralized collateral, where there are possible situation, like technically possible situation, where you could have your funds censored, frozen one way or another. With liquidity, as long as the Ethereum network synchronizes, it's essentially not possible. So I think this is one of the big main headliner for LUSD as a stablecoin. There are a few others. And for liquidity as a protocol, trying to stay short, and then maybe we can expand with some questions. But for liquidity as a protocol, I think, so of course it inherits those properties of LUSD, so the immutable code and so on. But there is also a dimension where it's very economically efficient with two main points, essentially. So the first one is that unlike the other CDP-based platform like MakerDAO, for instance, on liquidity, you don't pay a yearly interest rate. What you pay is an initiation fee. The default is 0.5%, and it can rise depending on the situation, but most of the time it's 0.5%. And so it makes it very economical for a long-term borrowing situations. So if you compare with a Maker Vault, for instance, they have several types of vault on ETH, but essentially if you keep the loan for a year, you will pay about 3 or 4 times less fees with liquidity, and you will pay them up front. They're predictable. And so I think that's also very interesting for long-term positions, because on other protocols, they can vary. For instance, on Maker, they vary with a governance vote. So that's like the first leg of this economic efficiency is the very low fees for long-term position. And just to close up, the second leg would be that because of the way liquidations work on liquidity, the protocol is able to stomach more aggressive collateralization ratio than what you can see in other platforms. And so it offers essentially bigger leverage for the same amount of ETH. Of course, there are risks associated with that, redemptions and so on. But yeah, I think it's definitely something users appreciate about liquidity too.
Mm-hmm. Thank you, Bryce. And then right away towards all panelists today here, because this was something that I was digging in the past 3 or 4 weeks, I would say. It was basically the topics of liquidation engines for CDP-based stablecoins, bad debt, which occurs when there is insolvent accounts, and basically there's like somewhat of a loss for the protocol. And I really started to think more and more about like what kind of lending protocols are out there, what are like the different mechanisms. How do you guys see that basically for CDP stablecoins? The biggest risks that are associated, I think risks with stablecoins is something that is very popular at the moment, also after what happened with Terra, right? So for CDP stablecoins, you guys would maybe agree that it's primarily the liquidation engine, which could be a vulnerability, but also possibly, for example, Oracle failures. Is this something?
Yeah, that's right. So actually, this is something we've been thinking of, is exactly the way liquidations work. I probably cannot really talk about everything right now, but yeah. So one issue with liquidations is currently is that they scale as like O of number of users, and you pretty much want for scalability of liquidations, you pretty much want O of 1, right? So that's kind of that's one thing, and which we are actually we want to tackle. And by the way, it's not only about collateralized stablecoins. It's also about lending protocols, because they have also have liquidation mechanisms. And so one thing is that if you scale your liquidations as something proportional to number of users, your you will have inevitably bad debt, like for small positions. And I don't know like how much it is for I don't know, for Avi, for example. It's pretty small, but it's still like still exists. So what I think with what we are doing, if let's say, I'm not saying that this number is correct. Imagine that 0.01% of funds is or 1 over 10,000 is bad debt due to this scalability issue currently. So I guess for what we are trying to do, it's gonna be 1 over 10,000 squared, which is much less, like 0.000 whatever. So a very small percentage. And another thing which as a user I don't like with liquidations, imagine that I had ETH collateral. So I borrowed LUSD using ETH collateral, and ETH dipped, my collateral got liquidated, and then ETH bounced, and I'm left with the proceeds of liquidation, which happened at low price, which is really bad. So that's why people watch liquidations really carefully, and increase their collateral position if they can, or repay debt if the drop happens. But really, it's like something which which doesn't let you sleep at night well, I would say that. And so we want to actually tackle this issue as well, because like really it can be better, right? So if it's but that needs rethinking liquidations completely, of course.
So there are some pointers to maybe what's coming, what's brewing up within Curve, right?
Yeah,
I just wanted.
For the hint, maybe you've seen that the it's gonna be powered by Llama with the letters AMM in it, with double M, which kind of hints that the key feature is AMM. So apparently,
right. But that's an important point that you bring up. And when we think about stable coins and liquidations, it just points to the fact that you can't look at stablecoin protocols in isolation, right? A large part relies on externalities like liquid markets, such that CDP-based stablecoin designs, at least, that the collateral can be liquidated efficiently. And so I think it's always very important when someone looks at like a stablecoin protocol that you always look at it like in entirety, including all these external factors that the protocol relies on. That's oracles, of course, which also relies on liquidity, but also liquidations, right?
Right. And with oracles, you're absolutely right. It's like in principle, we now have a lot of liquidity on chain, and in principle, you don't even need to have centralized oracles. But it's still not yet very well figured how to do safe oracles fully on chain. So and that's, I guess, why so many projects rely on Chainlink. It's like a really reliable, although maybe semi-centralized project, which still like probably the best for like what exists today for this purpose. But I totally believe that something which lives fully on chain and doesn't require any externalities can work, because in principle we do have an externality. We have redeemable stablecoins, and they by the fact that they can be redeemed to USD, they already can be the key for like having oracles on chain. But that requires, of course, some research on how to do it properly. So although it seems simple, it's not very simple to do it safe.
Yeah, and there was a few experiments using AMM sources for Oracle, mostly on Uniswap, but most of them ended up badly so far, as far as I can recall. So I think it's also, maybe it slowed down the research, I want to say, in that area, where I agree with you. Over the long term, I think it's a valid solution, or at least it's part of a decent solution for solving the decentralization of Oracle. But I think we're still missing this kind of middleware.
I think with Uniswap in particular, it's a good contributor, right? But for ideal Oracle, I would think that firstly, it's good to have continuous liquidity, like liquidity which doesn't go to zero anywhere. But if you do have sources from non-continuous liquidity, it's still good to utilize those. So maybe it's good to weight different sources by liquidity at the current price, right? So if you are at the edge of the price band or something, then it's probably weight should be much smaller than when you are at the price which gives a good liquidity. But really, like, it's again like building an oracle, but oracle which is not running by people. It would be oracle which is ran by smart contracts and aggregating all major sources of liquidity safely, and having a price oracle based on that would be a very I would say very good task, probably, which is not tackled yet.
And let's assume, there's like this website called RiskDAO, and what they, for example, do, they try to list all the different bad debts of like different lending protocols, and then you can basically see on how much bad debt exists, for example, compared to the total value locked within the DeFi application. I'm aware of like the case of waves or wires where I think they hard coded just one for I think it was neutrino USD, right?
Right.
And because I find it quite fascinating that this is even today, up to today, still possible, right? That somebody just hard codes like a one for like neutrino USD, and now they have like this trouble, right? That there is a lot of bad debt in their lending protocols. Like what can you do as like basically like DAO, or let's say as a community, to resolve this issue? Like, can it even be resolved?
Yeah.
I just have one question. Maybe I didn't understand correctly. I mean, you say hard code one USD for their stablecoin. That's actually what all the protocols do, right? I mean, Maker, everything internally, the accounting is based on, one DAI is $1, or one fiat in our case is $1. So that usually, is something that you see, right? But I think where it's more complicated is if you accept, let's say, USDC or let's say LUSD or whatever as collateral, and you hard code that as one USD, right?
Yeah, I think that's more like there is probably some similarity to Terra, because USDN has somewhat similar minting mechanism, and basically it's also collateralized by waves, as far as I'm aware. So which means that if waves price is manipulated up, and then somebody borrows at the top, and then it goes down, then some bad things may happen. I mean, it probably wouldn't if there was a cap, but I mean, if cap is too high, then this can happen. So this is actually what happened, and I guess probably the reason why USDN didn't death spiral like Luna is that like most of available liquidity for USDN was actually most of available supply, I would say, was sitting on Curve, and it's I mean, even if things are bad, it's it creates some resiliency, but resolving this is not easy, because like it's still the debt against USDN has to be repaid, or market conditions should change so that redeeming USDN wouldn't end up into debt spiraling. So it's a tricky situation. It's but I think the root of it is that this design, when you redeem stablecoin into this crypto which collateralizes it, and this crypto has some not very high market cap, or I would say real market cap, then I think it kind of invites for a trouble. Not that this doesn't work. Even Terra, I think, would have worked if it had limits on how much UST can be minted, or like soft limits based on this rate which you earn when you lock UST somewhere. But again, it's like so with these sorts of systems which are not just algorithmic, they are kind of collateralized, but collateralized by the protocol token, right? It although this token is useful for different other things, so it's not token which represents this stable coin necessarily, but when stable coin becomes the major use case, it can become vulnerable. So I think it just the minting limits should be kept much less than the market capitalization of the coin, and this is something where like this model can work, but some very serious research is needed. So it's much trickier model than CDP based stable coins.
Hey, Michael, I totally agree when you say you should actually look at Luna, in the Terra case, as the collateral to the protocol itself, because you can at a certain abstraction level look at stablecoin protocols like, balance sheets, let's say, where on the asset side, protocols have certain assets. On the liability side, they actually mint their own token, right? And then CDP-based stablecoin projects, Maker started out with ETH only on the balance, on the asset side, right? And more ETH than actually stablecoin on the liability side because it's over-collateralized. And then if you compare that, for instance, to Maker today, you have different types of assets versus one liability token, right? And in the Luna case, I mean, what essentially gives Terra the ability to intervene on the market and always bring back UST to $1, it's Luna, right? So Luna is the asset in that kind of mental model, right? And so even though those are not like CDP style designs, right, it's still that a certain token actually collateralizes the liability side.
Right. Yeah, you can totally get that issue with CDP-based stablecoins, and they are just a little bit easier to argue about. But yeah, if you collateralize by the protocol token, well, maybe you need to have a very, very large, very, very large collateral to debt ratio, and that's what Synthetics is doing, I think.
Yeah, right.
Yeah.
Yeah, I think go for it, Christian.
No, you go.
I just wanted to say, I think there's just a huge gap between the theoretical possibilities and success of those algorithmic stablecoins, for example, like UST, and where we are right now in the adoption cycle with regards to crypto. Because I think we would all agree that in theory, it is possible for an algo stablecoin like UST to hold its peg. The same way that it is possible, in the real world for real fiat currencies that are pegged to the US dollar, that are under collateralized. I mean, there are a lot of countries all over the world that peg their currency to the dollar, and they only have like 30% of dollar reserves backing those fiat currencies. And I think the main difference is just that those countries, they just have a huge amount of real world demand for those stable coins because people have to pay taxes in those stable coins, real world stable coins, I would call them. There's a huge, national economies running on them. There's international commerce happening on them. And in the crypto world, let's be honest, UST use case was just, speculation and number go up. And I think there's where we currently are in terms of adoption and real world use cases of those kind of stable coins. I think the gap between theory and practice is just way too big. So I don't see an under collateralized algo stablecoin happening and working as long as, crypto is not extremely well intertwined with the real economy.
If you want to compare like the algorithmic to CDP style stablecoins, right? I think, the algorithmic design is much more prone to failures in trust to the system, right? Because there is not, if you again look at it as a balance sheet, there is not at least an equal amount of assets backing the stable coin that's issued, right? Whereas for the CDP based stable coins, there actually is, or the risk is just that like the liquidation mechanism can't really cope with a huge liquidation spiral, right? So I think for me that's one thing where I think those designs differ. The algorithmic ones, they rely more or are more receptive to actually a trust crisis than the other.
Yeah, they're definitely susceptible to bank run. And we still have some example, I want to say, of live algorithmic stablecoin that find a way to solve it. But the way to solve it is to kind of reduce what makes the algorithmic model interesting in the first place. I'm thinking about Frax, for instance, where most of the stablecoin is collateralized. Can't remember the exact figure right now, but it's around 90%, if I'm not mistaken. There's still 10% that are algorithmic collateral, essentially, that are collateralized by the trust in the system and its mechanism to maintain and restore the peg. And so it works for Frax because of the way the protocol operates and the massive amount of liquidity they control. Essentially, the protocol is protected against the bank run thanks to the share of liquidity that the protocol controls directly on the stablecoin. But yeah, for pure algo stable, it's definitely a massive challenge. And we've seen that even with billions to defend the peg, like it was the case for Luna and UST. Once the crisis starts and there is a real lack of trust, it's a spiral and there is no stopping it. No balance sheet can stomach this, because when everybody is existing at once, it's essentially compounding towards the negative because of the link between the stablecoin and the token allowing redemptions against. So yeah.
We had a panel also about Terra, I would say like 2-3 months ago. And back then we were heavily discussing the redemption rate of UST against Luna tokens, because essentially what happened was that after one day, the DPEG was still existing. And we were all curious how the Terra case might have unfolded if the peg could have been restored within like one day, right? Because it's also what Nilos before said, that basically we have a trust issue at some point. And I really felt like the first day was bad, but on the second day, on the third day, it just got way worse. Like this was a bit of how I experienced it.
Yeah, and then I mean the spiral actually kicks in, right? And so when users want to like kind of lose trust in UST, they want to redeem it for Luna, which means actually more Luna is printed, right? And so like more Luna, is thrown on the market essentially. And so you kind of lose trust in the system. Prices may be, going down anyway, and then you throw more Luna on the market because people want to get out of UST. It just like that's the spiral, right? And it just kind of amplifies through that mechanism.
Yeah,
it's unrelated.
The reflexivity. No, sorry. I just, the reflexivity is deadly. And as I mentioned, if you have just 100% of UST holders that from now on to the next second would be willing and able and open to just selling the token to the market, it's what I just mentioned. There's like 0% lasting, sustainable real world demand of that token. Yeah. So basically, if in times of crisis, 100% of UST supply will just be sold, and there's no way out of those reflexive, deadly spirals in those.
Yeah, that being said, if you imagined that Luna, which UST redeems to, was having, let's say, 1 billion market cap, and if UST itself had token supply of, I don't know, $1,000, right? Just to make it ridiculous, which is 1 million times less, then it's probably obvious that redeeming to Luna would probably work really well. At this small cap limit. But when it becomes too large, then you have these death spiral issues, which is kind of the same issue as if you backed your CDP with merely your protocol token. So let's say if DAI was backed by MKR and only MKR, right? Then this would be an issue. And with Luna, it wasn't exactly that, because Luna has use cases beyond the stablecoin. But this stablecoin grew so big that it became the major use case on the ecosystem.
And the interesting part about Terra was probably also that after that, regulators were taking even closer look at stablecoins. Right. There's a lot of people who lost a lot of money. We also heard, I think, like a week or 2 weeks ago, that the UK is now going forward with the regulation of stablecoins in terms of, I think, e-money tokens. And that's also a question I wanted to ask you guys. Like MiCA is now basically up on us. There's now this regulation also in the UK. How do you think will this regulation affect decentralized stablecoins and then also basically the centralized counterparts, for example, USDC or Tether?
I really think it's going to be, as the regulation comes in, it's going to be a big revealer of how decentralized the various models actually are. Because again, just to go back to this end of the spectrum of immutable code, well, there is regulation can't do anything about that. You know, nobody can do anything about that. The code is here and it will live. On the other end of the spectrum, more centralized stablecoins, or like directly centralized stablecoin like USDC or USDT, they will work in direct collaboration with the government. And so, of course, it's not the same model here. My only concern, I fear, with the first regulations we're seeing is that I'm not sure this distinction is well understood on the government side. It seems like there is a lot of confusion between the various models. And so I just hope that the text that actually come into law will be considerate for this. Else it will be simply inapplicable.
Mm-hmm.
Yeah, but
yes.
Yeah, I agree that the decentralization is the key here. If something is fully decentralized, it's I mean, I think it has all the properties which regulators in principle should need, right? So it's like full transparency, so they probably can get whatever with that. And also when you actually go to real world, you do interact with regulated points which touch your identity. So in principle, they shouldn't really need anything from these stablecoins as they would need as nothing from like ETH itself, right? ETH itself cannot be cannot have, I don't know, KYC for transfers, right? For example. But there is also another aspect, like if you think about lunar disaster, it didn't happen because the system was centralized or not. It happened because the design of this stablecoin was vulnerable to it from the very beginning, and it wasn't that clear, especially when lots of Terra investors kind of were saying that otherwise that it's safe and whatever, endorsing it. But this is exactly maybe where regulators can and should weigh in, just to prevent advertising something which is too experimental as something which is safe yield and whatever.
Yeah, mm-hmm. So I think the first thing I want to say here is that you can hardly call Terra and Luna truly decentralized if you look at the open market operations that these kind of multi-stakeholders underwent during those last couple of days of Terra UST. But I mean, more generally on the regulation, just talking from the European perspective, I think MiCA clearly does not make any exemptions for decentralized or algorithmic stablecoins. So I think the first order effect will be that basically centralized exchanges, for example, and marketplaces, trading platforms will no longer be able to list those stablecoins that don't seek authorization and licenses under the EU MiCA regime. And that obviously will kind of hit and limit the utility of a lot of stablecoins. I mean, decentralized stablecoins included. If DAI will no longer be listed on EU exchanges, the real world use is obviously suffering because it's harder to off-ramp, DAI and use it for whatever, buying real world houses or cars or whatever.
Yeah,
so I think that is for sure negative for decentralized stablecoins and also centralized stablecoins that won't seek authorization. And then for Euro stablecoins that are decentralized or call themselves decentralized, the real question will obviously be, and the real test will be, how I mean, decentralized are they really? Because Euro stablecoins will be seen as a direct offering to the EU market, to the EU public. So I expect also some enforcement action on that front. And I mean, for truly decentralized, Euro stablecoins, I'm not worrying at all, because that's just software uploaded on the internet. But if we're honest, there are a lot of projects out there that are not as decentralized as they claim to be. And I think they will face some problems once MiCA is enforced. And to be honest, I expect a lot of them to pivot their business model in the next couple of years.
Yeah. So with this, with MiCA preventing exchanges from listing decentralized stablecoins, I actually don't think that use cases will trading with this stablecoin on centralized exchanges is so much of a use case at all, because like DAI liquidity on centralized exchanges is really small, and LUSD on centralized exchanges, I don't know, is it even used on centralized exchanges?
Just a few, but indeed it's quite limited. Most of the trading happen on Curve actually, or Uniswap, on decentralized exchanges. Yeah.
Right. So well, use cases right now are what? Borrowing against crypto, leverage. So I guess those, and well, as a store of value maybe, but I think store of value is probably the third of these use cases, not the first and even not the second. And I don't think actually much changes if decentralized stablecoins will not be able to be on centralized exchanges. And also, to be honest, I don't remember when did I use a centralized exchange last time, when I just use DEXs all the time.
Sure, yeah, I totally agree with you, Michael, but I just want to add two aspects to that. I agree with you, not much will change, but I mean, if we look at the current market, also 98% of stablecoins out there are centralized fiat-backed stablecoins, right? And if you say not much will change, probably that will also be true, for the mix of stablecoins out there. Because, I mean, in order to really become, a mass phenomenon, also for decentralized stablecoins, there needs to be some connection to the real world, to be used in payments, to be used, and those. So looking into the future, I think that regulation will be harmful.
Yeah, I agree. That's
right now, I agree.
The impact will be limited. True. This regulation could prevent some future uses.
Right, and I also think as an industry, we want to grow beyond like our current use cases and our current users, right? In terms of like the native DeFi people, right? And so I think it's like, first of all, events like, that around the Terra ecosystem are very harmful for the industry, because it actually, sheds a light on crypto that it doesn't deserve, really, because, it's like, it's not the intention of this market to live off of scams and stuff like that. Not saying Terra is one, but and so I think we want to grow beyond that, and I think we also don't want to necessarily run behind regulators all the time, right? And just wait for them to actually release new directives and stuff. So what I personally would like to see more, and also like especially the larger projects, because they have the resources, engage more in terms of like, aspects like self-regulation and just kind of protecting consumers and stuff, because we kind of want these use cases in our
exactly. So and if you think about it, regulators have at least the foundations of what regulators do are protecting consumers. And this is the problem we are working on all the time. So, and some self-regulating actions happen, like mostly focused about informing users. And I guess with this happening, hopefully regulators will have a lot to learn from. And well, some regulatory bodies even grew up from self-regulation. So, I mean, if we grow as fast as possible and make it, grow this like whatever we do for safety as much as possible, then I guess we probably can make crypto a safe place for consumers, and we'll see what regulators will say about that.
We have this amazing basis, right, which is like full transparency. Everything like that's governed on chain, that runs on chain, is just like fully transparent by design. It's just difficult for a regular user to actually make use of that because it's still complex, right? And I think one area, is definitely to kind of make more, transparent the working of those protocols or risks and aspects like that associated.
Yeah, definitely I agree that at the end of the day, I guess the biggest learning we can and we should draw from Terra UST is not so much about the stablecoin design, but more about the industry as a whole, how we communicate and how we self-regulate. I think one of the biggest issues with UST is that it was advertised as a saving product, like a saving account. And so it really gives a frame of reference where people were comfortable putting significant amount for them in that protocol, when at the end of the day, they wouldn't have put that in an algo degen stable farm. They just, if it was presented as such. And so I think that's really, where we're lacking as of now is, by this stage, you could expect the industry to be, for instance, I don't know, to have some kind of, we have some risk DAO, for instance, we mentioned earlier, Chris, you mentioned the bad debt dashboard. That's an amazingly cool initiative, but we should have this, but 10,000x, some kind of, maybe the top 20 DeFi protocols could probably each put together, I don't know, 500K, $1 million to fund some kind of a shared organism that will self-regulate. It's the only way we can prevent this kind of scenario from unfolding again. At the end of the day, I think it has to come from us, right, instead of waiting for the regulators to come and tell us this is okay, this is not okay. We already know what are the limits of what's acceptable or not. But it's a matter of enforcing them and making them clear, even for users that are not familiar with everything that's technical. And to just before I give back the mic, to build back on your point about, I really like the comparison with the fiat money, Patrick, and I think that was really smart. It's the same thing here, where we have something quite amazing where all the reserves are on chain and everybody can audit essentially any stablecoins or protocols they want. But the problem is it's out of reach for most people, because it's an information you have to process, you have to know how to contextualize and so on. And so, I think it really calls for, I want to say, a middle layer of information, of a kind of institutional organization that process all this data and make it more easily accessible to end users.
Yeah, actually, one thing I would be interested in, hearing your opinions is clearly right now, if we look at the market caps, centralized stablecoins have more trust, more use cases, liquidity, etc. So, for example, Michael, I'd be really interested to hear from your opinion. What needs to change from a design perspective, from a use case perspective, that those kind of more decentralized CDP stablecoins, in your opinion, will gain more trust and traction?
Well, I guess, of course, informing everybody about risks is good, but I think what is also good is making strong points of decentralized CDP-based stablecoins stronger. These basically the use case of borrowing is a very legit use case. So I think it probably should be explored. Well, Liquidity does explore that. So I think it's just moving in that direction. And of course, having good liquidity with the redeemable stablecoins is great, because after all, users want to go in and out to redeemable stablecoins and to real fiat money. I think that the use of CDP stablecoins as a method of payment, well, or store of value, it can come, but it's probably not going to be a major use case for a while, I think, and that's probably not something the project should seek for right away. Yeah.
Mm-hmm. And because we were just also touching before that on basically that everything is transparent on the blockchain, that we can see everything, whether it's for the CDP stablecoins. But then I would also just shortly touch maybe on the tokenized funds, so Tether and USDC. What I personally observed this year and also last year was that USDC, I think, became more popular, and I think also that the liquidity got way higher also on Ethereum, that there's way more USDC comparable for especially against Tether. And so I would also like to ask you guys, now that we had like the trouble with Celsius, with 3 Arrows Capital, which were very, very big players, do you see any risks with Tether, or is it like that you think they are used from quite renowned promised people, by that basically they are trustworthy, or how do you see that with Tether?
To be honest, I don't know like in detail kind of the structure, also the capital structure and so on, you know, in Tether. But one thing that's different for sure is that, so you have in TradFi also some sorts of, let's say, liquidity squeezes, right? And if you look at Celsius and these, the biggest problem was that they had assets, right? They just weren't liquid, right? And so because everyone had to sell their assets, the price went down, right? And so usually what you do in traditional markets is you are able to borrow short-term liquidity if you face such kind of like, you know, a freeze, right? In order to prevent exactly that, from prices to fall and fire sales and stuff, right? And I would say, without knowing like in detail, that actually decentralized players, because they are centralized, because they are in some legal jurisdiction where there is a central bank, they would probably be able to actually access such facilities where they can borrow short-term liquidity if really needed. And so, like, I would almost say that the risk for those from fire sales, like what we've seen with Celsius and stuff, is maybe less with those players than, I mean, at least if you look at you know, native DeFi project.
Yeah, I agree with that, Niels, and also I think it's, I mean, it's clear if you look at, you know, the stats that there was a flight to safety post Terra collapse. I mean, USDC gained market share, and I think that's mainly built, you know, on trust and liquidity. I mean, liquidity backs liquidity, and USDC is by far the #1 stablecoin in DeFi right now. And on the transparency part, I mean, I think it's hard for at least centralized companies like Tether to hold up with the level of transparency that Circle or even Paxos as the issuer for Binance USD and Paxos USD are providing, you know, with an exact write down of the securities they hold in the reserves, with what kind of banks, etc. And I think even if we look at, we were talking about, you know, future use cases and connections to the real world economy. If you look at who are the big tech companies cooperating with, if they look at stablecoin payments use cases, like companies such as, you know, Stripe or Visa or Checkout, etc., and they're clearly all moving towards using USDC. And I think just the level of transparency that they get there, I mean, they're clearly all engaging in some kind of due diligence. The level of security they get there, Circle has been, you know, very keen on getting regulatory approvals right from the start, on being as transparent as possible. So I think that's just unrivaled right now in the market, and that's why they're benefiting so much from this flight to safety right now.
Mm-hmm. Thank you, Patrick. And I think this was now a very good take on CDP, algo stablecoins, and also now shortly we touched on the tokenized funds. I would just use maybe the last 5 minutes to answer some questions from the audience. The first one, I find it very interesting. It's the question is from DM, and the question goes, how about mandating certain tests and stress tests to prove stability of algorithmic stablecoins under adverse conditions? So basically the questions towards somewhat of sandbox, where we could maybe do some economic experiments and then check for the vulnerabilities of stablecoins. This is something that maybe also Curve is currently looking at.
Yeah, well, I mean, maybe sandboxes can help sometimes, but if you think about technical issues, maybe, but what helps more is better testing before deployment. But for designs like algorithmic stablecoins, well, I'm not sure it would help because Terra's vulnerability got uncovered only at very large market cap, so it's experimentally uncovered. So experimenting on a small scale doesn't necessarily reveal what you may have at large scale.
Mm-hmm.
Yeah, more than the sandboxing, I think it's more about having some form of economic modeling before releasing this kind of projects.
Mm-hmm.
But it's really hard to do because we fall back to the discussion we had earlier, where essentially the gist of those scenarios are based on the lack of trust, failing trust, and then the wave of panic that stems from that. And I don't think you can easily model that with whatever assumptions that you have. You can get close to it, but it's at the end of the day, you need to have the stablecoin, I want to say, in the wild to see how it behaves in such scenarios.
Mm-hmm. And yeah, Patrick, did you want to say something?
No, I agree. I think there's just a trade-off between making those stress tests at the beginning of a project where it's kind of centralized, you are still able to do those, and then the real market testing that happens later on. And I think, I agree with Bryce. I think it just needs sound economic and financial modeling that is way more important, because I'm skeptical that you can test the kind of situations and the kind of panics that happen, in the real world at a later stage, at the beginning of those projects.
Mm-hmm. And then we have, I think this is more maybe of like a comment from Mike. Mike writes, the Bank of International Settlement recently published their guidance on stablecoins under the PFMI. Unfortunately, the suggested guidance looks like only suited for centralized and redeemable stablecoins. I think this is also something that you guys share from like the recent regulation, right? And then let me see. Yeah, Tyrus Ventures is also asking, maybe that's now a little bit unrelated to stablecoins, however, I will still ask it. He's asking, what is the panelist take on the Uniswap token, and that holders potentially receive some parts of the Uniswap transaction fees? I think this is quite common, right?
It's an entirely unrelated question, right? But an interesting one, because many are actually speculating or expecting, right, what's going to happen there. And I think it just shows one side of crypto or DeFi in general, where we look for how to optimally actually use those governance tokens and embed them in the protocol. So I think it's an interesting play. They have waited a long time with the discussion even, right? And it's interesting to observe what's going to happen now.
Mm-hmm. Okay, perfect. No, I think then also most of the answers got already, most of the questions got already answered during the session. For example, we had one other about Mika. And then now that we have already closed on 2 p.m., I would now finish the panel, end the panel. And I have to say, this was super interesting for me to see your takes on all these different issues that are currently out there. I want to thank also all of you for that you were participating today. Obviously also Michael, that you took the time. I guess especially right now with the release of the new stablecoin, you must be quite busy, and I'm very eager to follow up on everything you released. And just one last comment, because this really came to my mind between the last question we were talking about with Token Bryce, Patrick, and you, Michael. I feel like what's maybe a bit lacking still is maybe that the universities and the research needs to be a bit more involved, maybe with the DeFi protocols, because this is something where I really feel there is still like a lack of connection basically between the top 10, 20 DeFi protocols, which basically connect with the universities and then create really, really nice research output. And this would be something that I would hope to see for the future. Do you share that as like maybe last statement from you guys?
Absolutely. It's input from universities would be very valuable. I think the trick is that like these companies probably think much faster than universities do, but it's I think it will happen. It's many things are not entirely clear, and it would be like really good if universities contribute research to those things which are not super clear. And for example, I've seen one relevant research, for example, was I've seen recently was from ETH Zurich when they studied how optimal slippage parameter when you swap. It depends on liquidity, and it appeared that it's better to not keep this max slippage 1% or 0.5% or whatever, but to have it dependent on liquidity. Although they modeled it with Uniswap too, but of course it could be applicable in general. So just some idea which wasn't harnessed by the market yet, and which I think would be valuable. But there are many other things like that, I think. And I think universities will catch up, and industry will catch up with the university research when they come up with something good. And it just takes time.
I look forward to the day when the Professor Token Breeze and Agorov will, speak at universities and educate people.
I think it really goes both ways, because even for people that are in the academics, on the academic side, or other relevant specialty, it's quite an interesting playground for them. I think this is how I would see crypto. To bounce back on the transparency, is they have a system where literally everything is recorded on a ledger, everybody can access. It's quite different than what they're probably used to. And so I think it could be also insightful even for them. But yeah, I agree with you in the sense that I don't think this meeting has happened yet between the crypto crowds and the academics, but there will definitely be a lot of things to be learned when this occurs.
Thank you, Token Bryce. Perfect. Then I will end today's session here. Thank you very much again for being here today. It was a total pleasure and an honor. So I wish you guys a nice rest of the week, and then hopefully we see each other soon again, maybe for another panel in regard to DeFi. And that's it. Then goodbye.
Bye.
Thanks,
Bye,
Christian.
everyone.
It's
Thanks
been a
for
pleasure.
organizing, Chris.
You're welcome.
Bye-bye.